Welcome to tonight's live stream where we're here to discuss your decision of whether to take the lump sum or potentially take the pension from your company. So for those of you who are familiar with this decision, you know exactly what it is I'm discussing. If you're not familiar, a lot of times when you work for an employer, they not only provide you your defined contribution plan, which is a 401k, possibly a 403b, but you also have an account that is funded by your employer, and when you retire, you have the choice to either take a guaranteed lifetime income stream as in the form of a pension payment, or take that lump sum value, roll it over into your own IRA and invest it yourself. So we're going to go through some case studies. We're going to talk about the financial planning aspect as it relates to taxes, healthcare planning, of course, risk, reward. There's a decision that needs to be made. If you roll that money out, can you generate the same level of income? Taxes, going to be a really good discussion about taxes tonight, so get excited for that one. And we're going to go through some case studies and also share some good client stories. So I want to thank you guys very much for tuning in. And with me tonight, we have Lizzie and we have Ryan, longtime advisors here at Oak Harvest Financial Group. Guys, how you doing?
Good. How are you doing?
Good.
Doing good. Doing good.
So before we get into it, a couple of house cleaning items tonight. We have a raffle. So you should see at the bottom of your screen here pretty soon a QR code. Now, we usually give away one particular guide or one piece of information, but tonight we're going to give away our retirement toolkit. So I believe 5 different guides inside here, including our RSP, our Retirement Success Plan ebook, as well as a tax planning guide, a social security guide. Many really valuable educational pieces are wrapped up into this retirement toolkit. So register for that. That's what you'll receive. And in exchange for that, you will enter into a raffle for a $100 gift certificate to your favorite restaurant. Our marketing team will be in contact to coordinate that if you win, but register to receive the retirement toolkit. Not only great content, but of course the opportunity to win the gift card. We also have our market outlook, which is June 24th. I want to go ahead and announce that. So it'll be here on the YouTube channel. Chris Paris, Charles Scavone, myself discussing the sometimes violent beginning to the year in regards to the stock market performance. But here we are towards the back half of May, and the S&P 500 has regained all the value that it lost in the beginning of the year. So where is the stock market going from here potentially? That's what we're going to discover or discuss on the Market Outlook June 24th. So write that down. Okay, guys, lump sum or pension. So let me just start. I know we talked about, we want to get into what's called the GAT rate, and this is something that's very, very important to determining how much your lump sum is actually worth if you decide to roll it over. But guys, I'm throwing you just a little bit of a curveball here, was not expected, but any client stories, anything recently that you've dealt with? Ryan, I know you have one. We'll cover that when we get to the pension benefit guarantee, which is the entity that guarantees your private pension. But any decisions, any conversations you've had with clients recently regarding their lump sum or pension choice?
You want to start, Ryan?
Yeah. I think a really good time, just based on where we're going to go with the GAT rate and to explain how that works. 2022, when interest rates really started moving upwards and how those affect those potential lump sum pensions, we started getting a lot of calls from folks there towards the second half of the year where they're really worried about like that November timeframe when Ford Motor Company is actually a really good example of that. They're going to take a hit on their lump sum pension and they're planning to retire next year, so they want to retire early to take the full value of what they currently have of that pension. So that, that's a really good example of how that GAT rate can affect the decisions around the lump sum side of your pension. So I really just feel like that. Good segue.
And so for Lizzie, for those who don't know, what is the GAT rate? How does it impact this overall decision when it comes to, do I take the pension, the guaranteed lifetime income stream, or do I roll it over into a retirement account so I have a lot more money to manage for my other needs?
The GAT rate is, it stands for General Agreement on Tariffs and Trades. It's basically an internal rate of return that a lot of pension providers use to determine how much your lump sum is worth when you do decide if rolling it over is the correct option for you. It's based off the 30-year Treasury rate. So what we see is that it's an inverse relationship. So as interest rates go up, the lump sum pension option typically goes down, and vice versa. So currently in a interest rate environment like we're in right now, where it's anticipated that likely the interest rates will be going down over the next 6 to 12 months, as the feds have somewhat given clue to, it's very likely that those lump sum pensions can go or will be going up in the short term. Now, not every pension provider uses that rate to determine the lump sum, but it is kind of the industry standard, I guess you would say, Troy.
So I remember back when we were having our advisor meetings when interest rates were starting to rise and we were having conversations. Anyone you know right now that has a pension decision to make or a lump sum rollover decision to make, it's important to get on the phone with them and make sure they're aware of the consequences of delaying their retirement 6 more months or 12 more months. Yep. So if you have a lump sum or a pension decision to make, you should always understand where your lump sum value stands. In order to do this, you have to ask a couple of questions. So you contact your HR department, the pension company, and you ask them, when and how is the GAT rate determined for my lump sum amount? So GAAP, you can simply ask them, when is this, how frequently is this calculated, and what is the benchmark that is used to calculate what this interest rate is? Because when interest rates go up, essentially that's a higher discount rate. So they're discounting all of your future income streams from the pension payment back to some present value of today. And the higher the interest rate, the lower your present value is. So when interest rates are higher, your lump sum amount is less. When interest rates are lower, your lump sum amount is larger. So companies, I've seen companies do this every month. Sometimes they'll do it every few months, maybe every 6 months. I think I had someone not too long ago where it was only once a year. So your company will determine when the GAT rate gets determined or when your rollover, or excuse me, your lump sum gets revalued. And you need to know when. And also you need to know the interest rate that is calculated. So now we're in kind of in that opposite zone, Ryan, where interest rates may be coming down. So it could be a benefit to those who have this lump sum. But Chairman Powell has been pretty stubborn. You know, he's being patient. He's not really looking to lower rates. And I should point out that the GAT rate, as you mentioned, is typically based on the 30-year Treasury rate, and Chairman Powell only controls short-term interest rates. So there's no guarantee that when the Federal Reserve, assuming they do it sometime over the next year, lowers short-term rates, that automatically long-term rates will follow. There's a disconnect there. They tend to eventually move in that same direction, but don't expect when the Fed makes the announcement to lower interest rates for your 10-year Treasury or 30-year Treasury rates to drop precipitously, or at least in line with what short-term rates are doing, the 2-year Treasury, for example. Any stories back from a few years ago when we were having these discussions? I know I'm throwing things at you we didn't talk about beforehand, so my apologies there, but any conversations you guys remember?
I guess for me, one client sticks out where just what you were saying, Troy, and that we just really urged him to work with his HR as he was considering retiring first of the year, and that's actually when his pension was recalculated based on some rates, and it actually was more beneficial for him to retire like December 31st instead of January 1st, because that's when the pension was recalculated.
Yeah, and that's when it kind of gets, because a lot of times people are afraid to retire because, do I have enough? How long will my money last? If something happens to me, will my spouse be okay? There are all of these decisions running through people's minds, and then now all of a sudden we tell them, hey, you know, it's a big decision that you have to make, but the process would simply be call the company, determine when it's going to be revalued, your lump sum will be revalued, and they get that information and they come back and they say, okay, it's, you know, this is what the new lump sum will be, and a lot of times it's $100, $200, maybe more $1,000 less in their lump sum. So it really pushes up that time frame for them making a decision under, you know, some pressure.
Yeah. And I don't think the client would have necessarily known, because in his mind it was, okay, once I get to the new year, then I have my additional PTO that will pay out once I retire. So, you know, in their mind, they were doing the right thing by cashing in that additional PTO, not realizing that the pension would be so much higher that the actual payout would get them more money than that additional PTO in the long run.
Yeah. And it's important to point out, Ryan, that the pension payment itself, if you take the guaranteed lifetime income, that will not be impacted by interest rates changing, only the lump sum.
Yeah, and that's actually a really big consideration, what we ran into a lot at the end of 2022, because you have folks that are wanting to retire, you know, in a year or two, maybe even 3, and they're seeing this big impact, like you said, $100, $150, $200,000+ of their lump sum, and kind of, you know, for lack of a better way to say it, just kind of freaking out a little bit about losing that much of their money. Now they're trying to make a decision to retire before 59 and a half. And then that brings in a whole new set of considerations around there, because you take that lump sum, it rolls into an IRA, that's a qualified account, right? And so different considerations around that. There's always the rule of 55 of the 401k and different things to explore. But again, those decisions are made holistically, not necessarily in a vacuum.
So I want to come back to that, because you mentioned taxes, you mentioned the rule of 55. But first, we have a few people here I want to acknowledge. So Fast Eddie, thanks again for joining us. You're always here. We appreciate that. John Hunter. John says, hello, Ryan and Lizzie.
Hey, John.
Hey, John.
I think I meet with him tomorrow.
Oh, awesome.
Apologies for mispronouncing this, but Nagalapur is I'm going to make my best attempt there. Nagalapur. Says, I am new, I'm retiring from the auto sector in a couple of months. I am in a dilemma about my pension, taking the lump sum or the monthly income. Well, we're going to go through some of the considerations conceptually tonight to help you understand a little bit more about that. And we're going to be offering, so a couple things. One, in the retirement toolkit that we're offering in the QR code that'll be at the bottom of your screen, not only are you going to register for a chance to win a gift card, but one of the pieces in there, Heather, can you verify this for me, please? Don't we have a lump sum or pension in the retirement toolkit? Can you text Megan, please? I believe we have one of the guides that we're giving away is a lump sum or pension kind of guide for information there, so that'll be good. But we're also going to offer you, if you want, a 15-minute phone call with Ryan and Lizzie here, who have worked together for many years with our clients. So if you would like to just have a 15-minute conversation, get some of your questions answered, if you download that QR code, we can reach out to you and help you get that scheduled as well. Okay, Ryan, what is the rule of 55 that you mentioned when it comes to the 401k, and why is that important when it comes to making this decision about the pension or lump sum?
Sure, yeah. So I think first it's important to note, you know, with qualified accounts before the age of 59 and a half, there's a 10% penalty to withdraw from there. That's part of the consideration you have of investing in those. So the rule of 55 simply states that as long as you're of the age of 55, ahead of 59 and a half, because the rule becomes irrelevant after that, and you retire or leave, separate from service from a company, you can go in and access the 401k, assuming the 401k stays in that employer-sponsored account. You can go in and access it without the 10% penalty.
And so, because in this example, if you take the lump sum because you want to have more wealth, you want to be able to generate your own income stream, you want to plan for health care, for long-term care, or legacy planning. If you take that lump sum, you have to roll it into an individual retirement account. And Lizzie, that age 55 rule doesn't apply to IRAs, it only applies to 401ks. So you could be in a liquidity crunch if you don't understand this rule, because if you then roll the 401k over to an IRA, now they're both subject to the age 59 and a half restriction, instead of keeping maybe one at the company and qualifying for the age 55 rule and then being able to roll the lump sum over.
That's correct. I think at that point, it's really important to have a financial planner get involved, because it gets pretty complicated. The amount of planning that goes in, making sure, number one, you have enough money in that 401k that you have access to your income to bridge the gap from 55 to 59 and a half, right? Making sure that 401k is invested appropriately, so you're not taking on too much risk, knowing that you're going to need that 401k for income. And also the amount of planning that goes on with that IRA rollover. You know, do we have employer stock in there? That becomes a whole nother issue with some tax consequences that can be brought in. So, you know, just getting somebody who knows what they're doing and has the brain to make sure that we're planning in a way that's going to meet your income goals, risk tolerance, and longevity planning as well.
Because that's really what it comes down to, because you have the pension, and then you have to compare that pension payment that you'll receive for life, of course, assuming it's funded, and we're going to get into this in a little bit. You don't have to worry about the Pension Benefit Guaranty Corp getting involved. Ryan, you were telling me as a client, the company went bankrupt, and the client only received 60% of his pension, as opposed to the full 100% of the pension prior to the company going bankrupt. We're going to cover that in a few minutes, get into more details there. But when you look at the tax planning part of it, okay, we all know taxes are important for retirement. Obviously, it's not about what you make, it's about what you keep. And those tax-infested retirement accounts that you have, whether you roll the lump sum into an IRA or your 401k into an IRA, whenever you make distributions from them, you have to pay income taxes. And you also have to take required distributions once you hit age 73 or age 75, depending on how old you are now. But tax planning, when someone takes the pension as opposed to rolling it over, that's taxable income for the rest of their life. And talk to us a little bit about how that can limit some of the tax planning capabilities that maybe doing the rollover could provide.
Yeah. You take the annual income, say it's $5,000 a month. That's $5,000 a month for the rest of your life, assuming you know, some of the government pensions will have a cost of living adjustment, but corporate pensions typically do not. So it's $5,000 a month of taxable income, no matter what you do. Right? There's no way, unless you start giving to charity, which now you're giving your money away, so that's not even part of the conversation, but it's taxable income, 100%, and there's nothing we can plan for. It's just, it's going to be there. It's going to have an effect on a Social Security benefit, have those versus, you know, the lump sum. Now we have some potential opportunity to plan and navigate some tax planning techniques and things that we can to do to maybe potentially lower some taxable income in the future.
Yep. So Lizzie, as an enrolled agent, as a certified tax specialist, when you're doing tax planning for your clients, what's the worst type of income to have in retirement?
Probably ordinary income coming from your IRA.
or coming from your pension. So
yes,
they're both the same.
exactly.
They're both
Exactly.
the same. So how does it impact Social Security, for example? Because if you now take this pension, it has the domino effect, right? It's now ordinary income, you know, permanently, you know, on your tax return. That has trickle-down effects to Social Security income, correct?
Correct, yes. So the higher your income is, not only the more Social Security income is included in your AGI, but the more your Social Security is taxed under current law. Now, President Trump sounds like he may want to do something different with that, so we'll see how that pans out. But it's very true. Taking a pension leaves us not a lot to do tax planning wise. We're having more money in that IRA bucket really provides us with a lot more flexibility in tax planning, whether it's Roth conversion, charitable planning, really whatever type of goals you have, legacy, charitable planning, really whatever your goals are in life. Having more money in that IRA bucket allows us to be pretty creative with the strategies and the tools that we can create to help you create your goals in retirement.
So we have a few more people who are saying hello. So Jim B, hello from Wisconsin. Jamie Flores or Jaime Flores. How about if you have a city pension? We're going to discuss city pensions in just a few minutes here. He says, I believe you are in the DROP program. So DROP is an interesting program. We'll cover that for a little while. Before I go in, I'm doing a partial lump sum distribution. I guess it's not always all or nothing. Let's go ahead and go there because typically, I tell you what, before we do the partial lump sum, because there are some alternatives to what you can do with that partial lump sum, I guess even the full lump sum, if you think about it, but we first need to understand the language right? So if you have a pension statement and you look at your statement, oftentimes we have clients come in and they say, you know what, I'm completely confused. I have 17 different choices that to choose from, and I don't quite understand the difference between all of them. So there may be, so let's take one example. Let's say it's a single life with 5 years certain. What does that mean, Ryan?
It means, so like if I have a pension and I turn it on, it's guaranteed for my life. But if I were to pass away inside the first 5 years, it would continue for my spouse up to that 5-year period. It's guaranteed for 5-year period certain.
Yeah. So when you have a 5-year certain or a 10-year certain, if you take the pension, then you get hit by a bus the next day. If it's a 5-year certain, that pension will continue for 5 full years. After that, it's gone, no more. 10 years certain, the pension would continue for 10 years. If you pass away in the 11th year, there's no income. Now, if it's a joint pension with 5-year certain or 10-year certain, it's the same thing, except it's guaranteed for both spouses' lives. So, God forbid there's some type of accident and both spouses passed away in the first 5 years, and you had a joint survivor and 10-year certain pension option. You both passed away in year 5. The pension would continue to whomever you've named as some type of beneficiary for an additional 5 years, and then it would be over. There would be no more income after that. So 5-year, 10-year, 20-year, 30-year certain, and many people choose the life-only option with no period certain, and that's going to be the highest pension payment that you can receive because you are taking the most risk. If you pass away, there's no income for anyone if it's the single life with no term certain. We hear this a lot of times with annuities. So whenever someone comes in and they say, Troy, annuities are bad. Please don't talk to me about annuities because when you die, the insurance company keeps your money. Well, that's not true, but you can choose that option. So I think I've told you guys this story. We had, it was a few years ago, kids came in really, really upset. They wanted to file a lawsuit against the former advisor from some other firm. And they said, Troy, we went through this paperwork. We saw my parents put $200,000 into this annuity, and unfortunately they passed away, and now there's no death benefit. There's no way there can be no death benefit. And we had to go through the paperwork with them. Now, of course, we called the insurance company, got the paperwork, and the parents chose, whether intentionally or unintentionally, the maximum amount of guaranteed lifetime income with no period certain, which means that once they passed away, there was no more income for anyone. So it's not that the insurance company kept the money, it's that the parents chose that option. They chose to gamble on themselves outliving, or I should say living a very long time, and taking the highest amount of guaranteed income. So that's the same thing with your pension. If you want the highest amount of income, you can choose the single life option, no period certain. But most people, especially if you're married, typically choose either the joint and survivor 100% option, 50% option, or 75% option. They may be self-explanatory, but Lizzie, just what are the joint 100 versus joint 50% survivor?
So the joint 100% is you get the same payout no matter who's still living. So if you would predecease your spouse would continue the same amount of income that you were receiving. If you choose the joint and 50%, upon your passing, your spouse would get 50% of the payout. So when we're planning for two folks' lives, typically those are the options we like to see, just because we don't want to leave one spouse without that guaranteed income stream if one was to predecease the other.
And a lot of times the amount of annual income that separates the single life pension from the joint life pension, it's not a substantial amount oftentimes. Right. It's not like it's $50,000 versus $25,000. A lot of times it might be $50,000 versus $47,000. So it's a small amount relatively, but again, the company is looking at this $3,000 a year. It doesn't only have to guarantee the pension for one life, it has to guarantee it for 2 lives. So when they're doing their actuarial calculations, that's kind of how it breaks down, because 2 people should live longer than 1 person. So they have to pay more money out.
And when we talk about spending plans too as well, typically we do see a reduction in spending for clients once one spouse does predecease the other one, right? We only need one car. We're only living for, living expenses for one person, healthcare for one person. So typically, spending needs do decrease when one spouse predeceases the other. But there is what we like to call the widow tax, right, where taxes typically do go up at that point as well. So six one day. It's six one way, half a dozen the other, I guess.
So sorry to interrupt you there, Lizzie.
That's okay.
So we just put a poll question out, and where that comes from, and we wanted to make sure that we covered this. So the poll question was, do you know that choosing the lump sum could have a big tax hit? So we've seen this before, and the way this can take place is if when you take the lump sum distribution, if for some reason you don't roll it over into a retirement account, or you roll it over into a retirement account and then you distribute it. Or what I've seen in the past is people receive large checks and then they don't get those checks deposited in a timely fashion into a retirement account. So it's very important that you understand the proper procedure for rolling that lump sum account into your own IRA so you don't create a devastating tax hit potentially. But you guys feel free to go ahead and answer that question. So we have several people commenting here. Guys, if you have questions, we want to make this as interactive as possible. Nagalapur, let me know if I'm saying that correctly, please, but I see you asked us a question. $4,000 a month, I believe. I can't find it now, or $690. Here it is. So we can't give personal investment advice or personal advice without understanding your entire situation. But Ryan, what are some of the big considerations for him? Not financially, not what the percentages are, but how regarding how long he may live, his risk tolerance, other assets, legacy goals. What are some of those concerns that would go into that analysis or conversation when someone comes in and they want to, or they have the question, should I take the pension or the lump sum? Because you can there's the black and white analysis. We
Sure.
can compare it to a private market pension, or do the financial planning and say, hey, you know what, you might be better off taking the pension if you're just looking at the mathematical analysis in the black and white. But what we find is there are bigger considerations a lot of times that go into making this decision.
Yeah. I mean, the black and white's easy, right? It's a break-even analysis. How many years of taking the annual income is it going to take to equal the lump sum, which in itself, in a vacuum, is still not a great analysis just in itself. Generally, anything in the double digits generally kind of leans you towards the lump sum. Average corporate pension, I think, going into this year was around 16 years of a break-even. So, but we can't make those decisions like anything else. We just can't make them in a vacuum, right? We have to understand, so if we're going to take the annual pension, how's that going to affect our Social Security? Do you have rental income? Do you have any other type of income streams coming in? Asset-wise, how much do you have in qualified accounts, retirement accounts? And are we going to add another $750,000 from this lump sum into that? And so now we have, whatever it might be, $1 million, $2 million, whatever. That's a huge tax bomb waiting to happen, but something that we can also plan with, right? And so, and then, what's the, are we married? Are we not? What's the spouse's considerations? So if we go through and try to make decisions on any one thing, but in this case the pension, without seeing how it's going to affect anything else, we're going to leave something on the table that we could have probably been more efficient with, save some taxes, just maybe increase the amount of income we can live on. It just makes sense to look at it holistically.
Yeah, just making it in the vacuum is you're ignoring the planning aspect. You're just looking at it in the sense of, well, how much income can I generate from the $690 versus the $4,000 a month from the pension? But what if it's important to you to make sure that there is money for the children, if that's important to you at all? If you want to donate to charity, if you want to give money to people you care about. You mentioned the tax side of things, which Lizzie kind of touched on a little bit earlier. But what if you have what are known as non-qualified assets? So when we start to look at where your income is going to come from in retirement, we first want to look at how diversified your tax buckets are. So do you have tax deferred dollars? In this case, yes. if you roll it over, or you probably have a 401k? Do you have non-qualified dollars? So these are after-tax monies that are taxable annually, but you've already paid tax on that principal, and now you can withdraw from that principal tax-free. It's just a return of your own money. And do you have any tax-free? So now with those three buckets, when we develop an income plan, we're going to look at different, let's call it a different analysis for how much income to take from which bucket at which time, and then start to try to optimize your income flow for a couple of different things. We want to get you the most income possible. We want to maximize your income, and we want to help you pay less tax. So if we can increase the amount of income that you have over time while also helping you pay less tax, and go through and show you that's ultimately what we're looking at when it comes to that decision. It's not just the $4,000 a month or the lump sum, because even the Social Security you mentioned, Ryan, if you take the pension, how does that impact your Social Security timing? Does that mean now you're going to defer it later? Well, how does your overall plan look now with the pension and the Social Security? Probably pretty good, but most likely you're also going to have a smaller pool of assets later in retirement for healthcare purposes to pass on to family members. So where are your priorities? Let's identify those priorities, what you want to spend in retirement, who you are, what's important to you. And now, okay, we're starting to bring some color to this kind of black and white question, and that can help you oftentimes make a little bit better decision, understanding the full context. Lizzie, anything you want to add there?
One thing I will add is just understanding, or try to understand, your longevity, right? That's a really big consideration when it comes to the lump sum and the pension as well. So what is your family history? Do you have any ongoing health issues that could potentially decrease your longevity? That's definitely a big consideration when we talk about tax planning, and also what's right for you, lump sum versus pension. If you plan on living a long life, then the pension might be the right option, or we need to do some special consideration to negate longevity risk. But if you have some pre-existing conditions, or family history of some other conditions, then some other things might need to be considered in planning. And it's not something fun to talk about with clients, obviously, but that's what we have to do as planners, right?
Yeah. Well, we always joke around and say if we knew the date of death, job would be a lot easier, right?
Yeah, exactly.
It's just math equations.
Exactly.
So we have a special guest who just joined the chat, Nicole Riney. So Nicole, how are you? So
Hi, Nicole.
Hi, Nicole. Because Jaime brought up the drop, and Nicole. So Nicole used to work for the state of Texas in the state retirement department, so she knows the drop program better than anyone here at Oak Harvest Financial Group, and better than anyone probably at most firms. So Nicole's the one to talk to about the drop program. But the drop program, for those of you who are not aware, is a really good retirement benefit. One, we see a lot of policemen. We have a lot of police as clients. Firefighters, although that's kind of changed a little bit, but a really good guaranteed rate from the city on the savings. And a lot of times people leave the drop money there simply because they have a pretty good interest rate, and it's considered to be pretty safe. But it is more of a lump sum as opposed to a pension option. But a lot of times also there's a pension decision to be made with other monies, or maybe not a decision, because oftentimes a pension is just paid as part of the retirement benefit. The drop programs, it's a great program. We have a lot of clients that take advantage of it, but not as big of a decision sometimes as the lump sum or rollover. Now, one thing I will say with the drop program, I think the current interest rate is around 4.5% or 5%. The question then becomes, can you generate higher growth to either your income accounts or to your cash value? And that comes down to risk and reward. When do you need income? How much income do you need? Everything else that we've talked about from a planning standpoint. So if you do have questions, feel free to reach out to Nicole there. She'll be glad to kind of walk you through that. Okay, so Charlotte is asking how to sign up for the retirement toolkit. There's a QR code, and that kind of brings us to our first raffle. So Charlotte, I'll give you a couple of minutes. If you have not signed up yet, there will be a QR code that comes across the bottom of your screen. Sign up for that. We're going to do the first raffle winner tonight in just a minute. And we're going to do one more at the end of tonight's program. So we'll have that one coming in probably about 15 to 25 minutes, let's say. Okay. So let's go to, real quick, we're going to have to take a break for the raffle, but the Pension Benefit Guaranty Corp. So first off, Lizzie, what is the PBG, Pension Benefit Guaranty Corporation? What is it?
This is a organization that basically backs any type of pension systems that basically go bankrupt and are unable to fulfill their pension obligations to their participants. So it backs private pensions only, and unfortunately it doesn't back all of the benefits that are guaranteed to them in their private pensions. But it is kind of the catch-all for pensions that are underfunded and go underwater, essentially.
Yeah, and the private pensions, that's the big one you said. Because
private,
if you have a city pension, if you have a state pension, you're not covered by the Pension Benefit Guaranty Corp. So in just a minute, after I announce the raffle winner, we're going to look at some of the most well-funded state and city pensions and some of the least funded state and city pensions. And me personally, I know if I had a pension in one of these states or cities that was not very well funded, I'd be asking a lot of questions, right? I'd strongly be encouraging my local or state politicians to get involved, because it is a serious problem. And when, I should say, because for a lot of them, it's probably not if, it's more when they're unable to make their payments. I truly believe that millions and millions of people potentially could find themselves one day with a lot less retirement income than they were promised. So we're going to get into that in just a second. I'm going to go ahead and announce our first raffle winner. So Heather, who is it? Krishna Kumar? Krishna, congratulations. You are tonight's first winner. So our marketing department will be in contact with you to deliver a gift card to your favorite restaurant, $100. We want to thank you for downloading the Retirement Toolkit and tuning in tonight. Stay tuned. We have a lot more really to get to, but thank you very much. Okay, so I'm going to go ahead and pull this up. Eric, if you could switch over to my computer screen. We want to, okay, so we're going to talk about this for just a second. So what we have here, here's the website, guys. You can go through and look at this yourself, take a picture of your phone while I have it up, or just simply Google this is all I did. This is as of 2023, but most well-funded pensions, least funded pensions. And so we have this number over here. This is the funded ratio, so 184.6. In order for a pension to be considered funded, fully funded, it has to have enough assets to meet at least 80% of its future obligations. So the concept there is that if you have 80% of your future obligations in reserve on hand, then you're going to earn interest on that money. You're going to receive future contributions from current employees or the employer itself, the state or the city, and that's considered a fully funded pension. When you look at like Michigan, Washington, now these are specific plans within those states and within those cities. We see funded ratios of 184.6, 168, 122. These are astronomically, high pension funded ratios. These are not normal ratios. Most likely the state or city legislature has some type of requirement that forces certain funding level. But I don't know that to be certain, but it is uncommon to see pensions funded this well. So here's your top 15 here. We were talking about it before here. We see the Detroit one. They had massive problems back in, I believe it was 08. I believe some of them went bankrupt. So a lot of good ones here. And then we get to the bottom 15 for 2023. So if you are generally speaking in New Jersey, Connecticut, Kentucky, Illinois, some of the northeastern states particularly, a lot of those pensions, the city and state ones, they're in pretty bad shape. And ultimately what happens, now we don't get into whether, a lot of times what we find from doing this for a very long time and doing research on pensions is that a lot of times unions have negotiated such strong benefits for their members that a lot of times the benefits have gotten so high that it is unrealistic for those payments to actually be made and to be sustained. And that's what we see in a lot of city and state pensions really across the country. Okay, so here we have New Jersey, Missouri, Dallas, Illinois, Chicago, Laborers Union, Teachers Union, TRS down here in Illinois. So we see significantly underfunded pensions, 53%, 52, 52, 49, 48, 46. So these, if you happen to be watching and these are any of your pensions, you need to start asking questions, because the Pension Benefit Guaranty Corp that Lizzie mentioned, it does not guarantee state or local or federal pensions. It's for private corporations. So first thing we wanted to point out here is understand the funding level of your pension if you have one, and just be aware that 80% funding is considered solvent. It's considered fully funded because of what I went through earlier. Okay, so now if we kind of look at state pensions here, they have DC, which this is not a shocker to me. Honestly, District of Columbia, the most well-funded state pension in the country. I guess they're considering it a state because you have a lot of lobbyists and politicians that have made sure that their pension, probably by law or through lobbying, that the pension is very well funded. So they actually have a $728, looks like, $1 million surplus. The negative number is actually a surplus because these are the unfunded liabilities. So actually 107% of what it owes, it has on hand, and that's a very, very, very strong state pension. Now, when we start to get down here, we start to cross over this 80. I'm going to pause it here. So Nebraska, Wyoming, West Virginia, you can kind of go down the list. These are all state pensions. You want to find out if your pension is part of the state system here, and this refers to you, all in pretty good shape. California. So interesting with California, they actually have a law in California that requires the pension to be paid annually, the pension payments. But almost a $300 billion unfunded liability, but they have laws to protect people in that state. That's why it's basically at 80% funded. Now, that's also why you have tremendously high taxes and other issues out there. But then we start to get into Texas, Kansas, Alaska, all in pretty good territory here, but we're starting to kind of go down the list. And really, these are the ones that I would be concerned with if I were in these states. You know, Montana, Alabama, Colorado, Massachusetts, Pennsylvania, New Mexico, Hawaii. Obviously, the further you go down the list, if you have a pension from one of these states and it's funded by these states, guaranteed by these states, you have no Pension Benefit Guaranty Corp, and you really should just check into the solvency of your pension. I'm not saying it's going to go away. I'm not saying anything other than the pensions are significantly underfunded, and typically there's some reasons why. I would just start to learn so you can make a better decision about your retirement, and if you do have an opportunity to roll that money over, it may be a good choice, but definitely you want to learn more about it. Be aware, that's the first step. I kind of rambled there for a long time, guys. Anything you want to add?
It's important to understand whether it's the state, the city, federal government, your corporation you work for. It's important to understand these type of numbers of your pension when we talk about the decisions you have in front of you at that time.
Okay, so have another poll question here. Would you consider rolling your pension into an IRA for more control and flexibility? Of course, they mean a lump sum. What was the results? I guess, I don't know if I can see the results of the poll here, but Heather, if you can let me know the earlier poll. I believe we had one about whether people wanted to have more control of the money or if they'd rather have the security of the pension. Just curious what the results of that poll were. Okay, so someone brought up the comment earlier. It's not always an all or nothing decision. Some pensions will give you a partial lump sum option. So maybe, well, I'll let you guys kind of explain it. What's the partial lump sum option?
Okay. Yeah, so a lot of times companies will, reduce the annual payment by the 50%, which is based on time value of money. And so then you essentially get access to half of your lump sum up front, and then you'll take essentially half of the annuity each year. TRS here in the state of Texas, they'll do like a 1, a 2, or a 3-year income option to reduce the lump sum, but also reduce the annuity going forward. So it's another consideration in all the decisions. And a lot of times when you have those options, it gives us more flexibility to navigate through all the other decisions that we have, how we're going to income plan, tax plan, right? Your legacy, always important to most people anyways, just depends. But all those considerations are just that, right? Something to consider.
Yeah, so instead of it being a all or nothing decision, let's say you have an $800,000 lump sum to roll over, you either do it all or you take the pension payment. Some pensions give you the choice of saying, you know what, you can do $800,000 and get no pension, or maybe you only want to roll $400,000 over and then use that other $400,000 to receive some type of partial pension. So essentially you get options, you get choices of different levels of a lump sum that you can roll over and different levels of pension that you could elect to receive. Okay, I'm going to come back to you from a tax planning perspective and also an income planning perspective, Lizzie. What's a situation where, in that context, where taking a partial lump sum may make sense for someone?
That's a good point, Troy. It depends on what your income goal is, right? Maybe the lowered pension amount makes sense in filling your income bucket from having a lower pension, but you have higher Social Security and you don't need that full pension payout. That allows us to plan with the lump sum money to do Roth conversions, to make you more tax efficient later in life, to reduce those required minimum distributions. And it's actually a really good option for a lot of people. I feel like it can be really overwhelming for people with all of the options we talked through today. But that's just part of the planning we do here at Oak Harvest, and understanding what are your income needs and how do these specific pieces play into filling that bucket.
Yeah, the big one there that we see a lot is when you have other assets, right? So you have an IRA already, or you have some non-qualified assets, you have a 401k that you're also going to roll over, and you say, you know what, I really like the stability of some guaranteed lifetime income, but I also really want this money because maybe I need it for healthcare later in life. Maybe I need it, I want it as a death benefit to pass on as part of my legacy to my children and grandchildren. Having that partial lump sum option is attractive for a lot of people. I mean, I sat with someone, we went through, he's an engineer. We have a lot of engineer clients here in Houston. I'll kind of never forget the conversation. This was back before we had a lot of the fancy software tools that we have today, and it can do a lot of this analysis for us. We ended up putting together spreadsheet after spreadsheet. He put together spreadsheet after spreadsheet, and literally for 6 months, because he knew this moment was coming where he was retiring, we looked at this 6 ways from Sunday. Finally, he comes in and he says, Troy, I'm just going to do half lump sum, half pension. I can't decide. I'm just going to split the baby down the middle. We spent hours and hours, dozens of hours helping him make this decision. And ultimately, it just came down to his gut, and that's okay, right? It was just a gut instinct for him. And, he was actually, this happens a lot with engineers. I know because if I wasn't an investment advisor and retirement planner, I would probably be an engineer.
Probably true.
It's all making sense, Troy.
And sometimes you just analyze things so much that you get into this state of inaction, and ultimately, you're like, I'm just going to trust my gut anyways. So I know there's a lot of times where I would have been better off just trusting my gut from the get-go. But I tell you what, we have, so here are the options yet. So if you had to choose today, which pension payout option would you take? Lifetime income, 37%. Lump sum, I want control of it, 29%. So that is 66%. And then the others are not sure. I don't have a pension. And I'm just here for the gift card. That's actually not an answer, but... So here's, a lot of times you only have the full lump sum or the pension payment to choose from, but you can make your own private market pension. You don't have to just choose all the lump sum and go invest it all at risk. you can make your own private market pension. And I'll tell you what, now that interest rates are higher, this used to not be the case, but if you roll over the lump sum, the full lump sum, let's say you have an $800,000 lump sum, you roll the full thing over, you can take, let's say, half of it and essentially buy your own pension from a life insurance carrier in the form of a stream of guaranteed lifetime income. And that stream of guaranteed lifetime income, for many of you, the income would actually be higher than the pension that you receive from your corporation, because the pension formula, it's not fixed. It's based off life expectancy, it's based off the returns of that corporation, it's based off many different factors when they give you your sheet that lists what your lump sum is and of course what your lifetime income payment is. It's not standard or standardized across the industry. But insurance companies, on the other hand, they offer essentially a guaranteed lifetime income through the form of an annuity. So a lot of times we see people say, you know what, I want some guaranteed income. I like the concept of having a baseline with Social Security and a guaranteed income stream, but I also want, $300,000, $400,000, $500,000, $600,000 of that lump sum, and that provides a lot of flexibility from a planning perspective. And you guys are looking a lot of times at these comparisons, on a daily and weekly basis. I know 10 years ago, the fixed annuities and the guaranteed lifetime income products, they really couldn't compete with pensions if you wanted to take your income, this year or next year. But now these guaranteed lifetime incomes, they're very, very comparable. So it's almost like you can have your cake and eat it too, where you can take the lump sum, have a guaranteed lifetime income by purchasing your own. But in that instance, let's say they were identical, you actually can still have your principal. You don't have to forego access to your principal while receiving the guaranteed lifetime income with certain types of fixed annuity products on the marketplace.
Yeah. Plus, if you really think about it too, you kind of spread your risk, right? So one of the things we talked about is the solvency of a pension fund, right? You can take some of the risk from there and put it elsewhere, where you have different protections and different things to protect your money.
Spread it out across multiple insurance carriers if you like them?
Or just half pension, half insurance in that case, right? If we have comparable incomes. Just spread the risk if you're uncertain about
if you have that partial lump sum option.
Mm-hmm.
Yep.
Yeah.
Again, so your client that had a pension from United Airlines,
Yep.
it was,
Yep.
When they went bankrupt back in, I said it was 05, I think you told
Correct.
me?
Yep.
He was expected to receive a significant pension, and 60%, Ryan, as you said, what he ultimately
Yep.
received?
Yep. They got the max amount that they could get at the time based on his pension, which was 60% of what he should have been getting had they not. And a lot of times, not to 100% validity, but a lot of times one of the first things to go when companies file bankruptcy is a pension,
Yep.
right? And so this was the case with United Airlines, and thankfully PBGC was there for them, because if it's not, then you get nothing, and this is a huge part of their retirement package. And,
Yeah.
but what we, the work that we did to create different things, and they're really on a really good path now, and things are looking really good for them.
So Eric, could you kind of come back to my screen here? So for those of you who have a private pension, I'm going to go through the Pension Benefit Guarantee Corp as of 2025. Now I want you to go to this page and go through it yourself, because it is complex. And it also depends if you have what's known as a single employer plan or a multi-employer plan. So a lot of times, if you're a unionized trade and private corporation, not state, city, or federal, you often have a multi-employer pension plan, and the protections offered to you are minimal, very, very, very minimal. So you want to make sure you understand if you're part of a multi-employer plan or a single employer plan. But here we have the single employer plan. This is why it's complex, and I really just want to refer you to the pbgc.gov website so you can learn more. I'm on you can kind of see the URL here. If you want to Google it, PBGC, Guaranteed Maximum Monthly Benefit. What's important is it's based on your age, because pensions are an actuarial calculation. So if you're a male, you're expected to live this long. If you're a female, you're expected to live this long. Depending on when the employer files bankruptcy and how old you are and some other factors, there is a maximum guarantee for what they will provide in form of replacement income if your corporation goes belly up. So here's the chart. So on a straight life annuity, if you're 75 years old and your corporation goes bankrupt, they're going to guarantee $22,000 a month. That's pretty good for someone who's 75. The reason being, you're not expected to live as long as somebody who was 61. Now, we get down here into the range where most people are making these decisions, and you see it starts to get a little bit dicey in between the ages of 60 and 69, depending on what level of income you had, what your pension benefit is. It's just, again, not saying this is good or bad, but the goal is to help you understand so you can make better decisions with your money. And then on this column over here, we have the joint and survivor pension guarantees for a private corporation through the PBGC. Now, multi-employer plans. So same thing here, just Google the PBGC multi-employer facts or multi-employer guarantees, because this is even more complex. But I just kind of want to show you this here. So if you are 30 years of service and 65 years old, the PBGC cannot guarantee more than $12,000 per year, $12,870. So 30 years of service, 65 years old. If you are part of a multi-employer plan, this is your maximum guarantee as of this year. 20 years of service, 10 years of service. Again, determine if you're a single employer or multi-employer plan. Oftentimes it's the unions, and also trade businesses, private corporations or private entities that are trade businesses and are unionized. Oftentimes they have the multi-employer plans. But do your own reading, do your own research, ask your own questions. Our job here is to hopefully guide you in the right directions by making you aware of some of these considerations and then helping you to point you kind of in the right direction to learn more. And hopefully 1, 2, 3 of you will really truly benefit from this. Hopefully more, but let's be realistic here. So I want to get back to the guaranteed income, because one of the things when we look at, let's say you don't need the full pension amount right now, okay? Let's say you have some other assets, and let's say you really value the lump sum because maybe you have some health considerations, or maybe you just want to make sure long-term care is taken care of later in life. When we start looking at when people want to take the lump sum, but they also want guaranteed income, so we can take a portion of that, carve it off, and purchase some guaranteed income in the private marketplace. One of the things that oftentimes is very beneficial to people are what are known as long-term care doublers.
Yep.
So Ryan, tell us what a long-term care doubler is and how that compares to a pension income.
Sure.
From a corporation.
Yeah. So on the private income side that we're talking about, the guaranteed income, there's a lot of opportunity out there where companies will give you double the income. So if your income is $20,000 a year from this, they're going to give you $40,000 for up to 5 years, and they'll do that based on you not being able to meet certain targets, such as 2 out of 6 activities of daily living. Of course, as certified by a doctor. There's
different terms and conditions from different
Right.
carriers and different products in the marketplace, in the annuity marketplace. But there are a lot of fixed annuities that, let's say you have a $300,000 lump sum, where you roll it over and buy your own private market guaranteed lifetime income. Not only is the income similar, but with this income doubling feature, let's say you're getting $30,000 a year from each. Okay, but you have long-term care concerns later in life. That could be kind of the tipping point for a lot of people, because you could have an additional $30,000 per year for up to 5 years, where your lifetime income doubles to help pay for long-term care, home health care. It's just important to point out that 10 years ago, there were 1 or 2 companies in the entire marketplace that had these lifetime income doublers. Now there's probably 15 or 20 companies and 30 or 40 or 50 or maybe even 100 products. They're not all the same. There are terms and conditions, and you need to understand those terms and conditions, of course. But in general, if you find one that fits your lifestyle and what you're looking for, it can be a very strong benefit to know, not only do I have a comparable income from a private market annuity for guaranteed lifetime income, But if I need long-term care, that income will double for usually up to 5 years. Can be a big advantage.
Which is generally about the average need,
Yeah.
right, of long-term care anyways.
Yeah.
And I think it's fair to say it's not in itself designed to cover necessarily all of the long-term care, but it's a provision in there that's there. So it's just another advantage to think about when looking outside of the pension.
Okay, guys, so we're coming up on our last raffle of the night. So if you have not already registered, this is an opportunity to win a $100 gift card to your favorite restaurant. So there's a QR code that's at the bottom of your screen. This is your last opportunity to register for the raffle. What you're going to receive is the retirement toolkit. So the retirement toolkit, going to do a couple of things. First and foremost, and thank you again, the lump sum or pension is not in there, so we didn't make that as part of the retirement toolkit. We made this essentially a couple of weeks ago before we even decided we were going to do this. But what you're going to get is our Retirement Success Plan ebook. So the ebook has links to pertinent videos on YouTube and also educational content about Oak Harvest's Retirement Success Plan. Step 1, risk management, allocation planning. Step 2, income planning, tax planning, healthcare planning, and then legacy planning. Our RSP ebook, the 10-step layoff guide, the tax planning guide, the Social Security guide, and there's one more, Heather. No, the one more in the oh no, you gave me the list over here. The ABCs of fixed indexed annuities as well. So if you want to learn a little bit more about those, there's an annuity guide in there as well. So you're going to receive the retirement toolkit, but in addition to that, if you have a lump sum or pension decision, we're going to set up a 15-minute conversation discovery call with Ryan and Lizzie to kind of go through your particular questions. Ryan and Lizzie work together, so maybe Ryan and maybe Lizzie. But if you have questions about your particular lump sum or pension decision, we're going to do this at no charge. It's a discovery call, understand more about your situation, who you are, and if there's an opportunity to work together, great. If not, we're still going to help you out, answer some of your questions. So go ahead and download the QR code. Heather, give it just one more minute here. So anyone who has not registered yet can register. And we're going to look at a couple of the questions here. So Craig Owen says, can you explain the high wage earners pension limits? Yes, so essentially just based on the amount of your adjusted gross income, it's probably modified adjusted gross income, but based on a certain level of income, there are limitations imposed on how much your pension can be guaranteed. So remember when I said there were other factors, so it's not just about your age, it's not just about the company's calculations. When it comes to the Pension Benefit Guaranty Corp, your income is also a part of that equation. So that's why I wanted to direct people to the website because it is complex. It's not Pension Benefit Guaranty Corp is not exactly my area of expertise, but it's hopefully pointing you in that right direction can help you understand those limits a little bit more. Okay, guys. So Nagalapur says, I wish we had the 50% pension and 50% lump sum option, and I am an engineer. If you want to look at some of those options, you can look at that. Because again, you can purchase a private market pension and take half of the lump sum and then use the other half to purchase your own guaranteed lifetime income. And a lot of times it can be more than your pension. And it may not be, but at least you'll have that information. So if you want to do that, just let us know. Okay, Heather, who is the winner for our last raffle tonight? Monica Baker. Monica, congratulations. So our marketing department will be in contact to help deliver the $100 gift card to your favorite restaurant. Appreciate you tuning in tonight, and hopefully you enjoy the retirement toolkit. Okay, so Jaime says did not accept the package. I assume you're talking about your either lump sum or the you're talking
severance.
About the severance. So so you're probably talking about the City of Houston, the recent package that they offered with the severance payment and early retirement. Okay. Guys, any other comments? I'm kind of just going through here to look for any other questions that that are pertinent to the entire group here that I can go through. But any kind of closing thoughts or comments?
It's really like pensions are a lot like a lot of things that we look at in the retirement planning financial industry. There's a lot of complexities with them, and we can't really just try to tackle it all on its own. We really need to make sure we're looking holistic with everything that we do. So I just think it's important, if you don't know where you're at, call someone.
I agree.
Lizzie agrees. So one thing I will add here, and it's, I think from a retirement planning standpoint, one of the things that I really do appreciate about pensions, they create some limitations on the tax planning side. They create some limitations as far as what we can do down the road. But they do create a lot of flexibility when it comes to your Social Security income. Most of the cases that we look at, if you do have a pension, it creates a wide range of Social Security outcomes or possibilities as far as when you can take income, because when you have so much guaranteed lifetime income, whether it is from an annuity in the private marketplace or pension from your employer, the more income, the more steady, secure income that you have in retirement, from my experience, typically those are the most happy people in retirement, because when the market gets crazy and wild and volatile, the people who have income coming in regardless of market performance tend to be the people who are least emotionally impacted by the wild ride that the stock market creates. Me personally, I'm a big fan of guaranteed lifetime income. I've just seen it be such a powerful tool in not just the retirement planner's toolkit over the years, but the client's toolkit. Knowing that you have Social Security and another stream of guaranteed lifetime income coming in from the emotional side of retirement, it makes a big difference. It really, truly does. So whether you have a pension from your corporation or you do not, finding some way to add some more income to your retirement oftentimes is one of the keys to happiness and stability in retirement. So with that, I want to do two things. I want to remind you of the market outlook that we have coming up June 24th, where Charles Scavone, Chris Paris, and myself will be right here on YouTube discussing the wild ride that we've had in the first year in the equity markets and potential directions we could go in the second half of the year. President Trump's tax bill is on the table. They're negotiating it right now in Congress. We should have some type of information on that and its impact on the stock market in the coming weeks. And then, of course, we're going to look at what could go wrong in the second half of this year, which could impact your retirement. That's June 24th right here on YouTube Live. We hope we see you there. And if you do want to schedule a 15-minute conversation with Ryan or Lizzie to discuss your lump sum or pension or any retirement question that you have, you can reach out to us to get that scheduled as well. With that, I want to thank you very much for coming to tonight's lump sum or pension live stream, and we hope to see you soon. Have a good night.